Having been doing business in China for 14 years, Fullerton became the first Singapore-based asset management company to be approved for dealing on the China interbank bond market in 2014. With its wholly foreign-owned entity in Shanghai, the company launched its first equity private fund in China in 2018. Since then, it has been offering services to not just overseas clients, but also to domestic investors. And it's been good business. Its investments have seen an annualized return rate of 14.6%, and the company is looking forward to more.
The A-share market is behaving quite reasonably, and as the Chinese economy continues to grow, listed companies have high-quality assets with large profit capabilities and potentials. And since the outbreak, China's overall monetary policy has remained relatively loose. So we're optimistic about the mainland stock market and the bond market as well.
The growing market is showing it's attractive to plenty of newcomers as well. JP Morgan has just announced that the regulator has given it the green light to take complete ownership of JP Morgan Securities China from its 4 Chinese shareholders, making it the first foreign firm to fully own a securities venture here. The company says that China represents one of the largest opportunities in the world for many of its clients and for itself, and it will also help Chinese companies grow internationally. These developments not only highlight the enthusiasm for foreign financial institutions for operating in China, but also reflect Chinese regulators' resolve to advance financial liberalization. In recent years, more than 100 foreign invested banks and insurance, securities, payment, and clearing institutions have been approved and set up here. They've been actively expanding the scope of financial businesses, especially since the Chinese government scrapped foreign ownership limits on securities firms and mutual funds last year.
We help companies with their business registration, location choices, and recruitment. We are working on spreading information about our policies so as to let overseas firms better understand us and strengthen their confidence in operating here.
Experts say the arrival of the foreign invested financial institutions will bring more diversified financial derivative products and businesses to the mainland market, accelerating its upgrading and internationalization, but at the same time potentially putting pressure on domestic firms.
Domestic firms are good at serving local firms, raising money domestically. In terms of business transactions, due to their lack of retail channels and their lower commissions, overseas firms will probably avoid competing with local firms in traditional retail business transactions and credit trading. But they will present great challenges to local firms in serving high-end or high-net-worth clients.
In the first half of this year, overseas investors increased their holdings of yuan-denominated bond by over 450 billion yuan, up 40% year-on-year. And a State Council executive meeting in July announced that China's financial liberalization will continue. Regulations on cross-border transactions between parent and subsidiary firms will be improved, and there are to be more ways opened for foreign capital to participate in domestic financial markets. 张世璇 Money Talks.